Thank you very much for having me here. I'm going to start talking about our quarterly outlook, which is something I hope that you have read or you have in your inbox. But the main takeaway from our quarterly outlook is that if you have cash lying around and you don't have it invested, you are losing money in real terms. In this chart, you see two lines. The blue line is the real Fed fund rate. So basically, I'm taking the Fed fund rate minus US core CPI, and that's above 1%. It means that if you take your cash and you invest it in short-term US treasuries, which are risk-free, not only you will be able to create a buffer against inflation that continues to be around 4%, but actually you will gain above 1%. Above inflation, and that's new. It's new for markets because we didn't have such high real rates since 2007 until today. We shortly had between 2018 and 2019, but definitely this looks to be one opportunity that we weren't presented for around 15 years. Different is when we look at the ECB and what's happening in Europe. It's the gray line that you see in the chart. That's the real deposit rate, and as you can see, it's still negative. But it's close to 0%. And that line is telling you that if you don't have money invested in safe havens, so short-term European sovereign bonds, you are losing money in real terms. Actually, you are losing more money than that negative minus 0.3%. But what's the situation now with central banks and what we can expect from them going forward? So we are at a point where the Federal Reserve has hiked interest rate by 525 basis points in the past 14 months. That has been the most aggressive tightening cycle that the Federal Reserve has undertaken in the past 25 years. And the problem with that is that despite the huge increase in interest rates, the expectation on markets, and that's what you see in that chart, break-even rates, swap rates on inflation, they are still well above target, and actually they started to pick up higher as of recently. So what does that tell us? It tells us that the Federal Reserve needs to keep hawkish bias and needs to keep the financial conditions tightened in order to continue to fight inflation and to for it to be possible for inflationary expectations to revert to their means. We have a problem though. And the problem that we are having is that the Federal Reserve has hiked by more than 500 basis points. And although we have seen it posing, the long-term bonds started to sell off and the long part of the yield curve started to rise again. Why this is happening? It's happening because of several reasons. First of all, the Federal Reserve, as I just mentioned, cannot initiate an interest rate cut cycle. Normally, when the Federal Reserve central banks as is done with the hiking cycle, the bond market positions already for cuts. But this has not happened yet. And the reason for that is that there is a lot of uncertainty regarding inflation, if it's going to rebound, and especially when it's going to revert to its mean. So until we have that message of higher for longer, it's very hard to see long-term yields to fall. Actually, it's more probable for them to rise. Why? Because if now I look at the bond futures, they are not pricing rates to drop below 4% in the near future and never for the next 10 years. So if I have interest rates that are never go below 4%, the long part of the yield curve has to price above this level, which historically has been around 80 to 100 basis points. And where does that take us? It takes us around 5%, where we are now. There are also other forces that are forcing long-term yields higher, and that is quantitative tightening and the bigger fiscal budget deficit, which means larger coupon supply. This is a demand supply problem, which we didn't have previously because the Federal Reserve was there buying bonds with quantitative easing. But quantitative tightening means that the Federal Reserve now is not buying, actually, it's selling, it's not reinvesting the bonds that are running off its balance sheet. And then, for last, we have a big question mark when it comes to Japan. We see that Japanese inflation finally has picked up and is not reverting fast enough towards 2%. So what does that imply? It implies that the Bank of Japan needs to be tweaking and modifying the yield curve control program that initiated years ago, and that means that the JGB, the Japanese sovereign bond yields, need to rise. If that is true, Japanese investors that are the biggest holders of U.S. Treasury debt as well as European sovereign debt will have no scope to buy U.S. Treasuries or European sovereigns because once that they hedge it against their own currency, they will get a negative return around minus 1%. And right now, 10-year JGBs are paying around 0.85% clean without currency risk. Then I'm gonna shift towards the discussion of stagflation, because this is a tail event. We are already living in a stagflationary environment in Europe. We are heading towards a stagflation in the US. What is a stagflation? Stagflation means that we are going to live in an environment with high inflation, high employment, and sluggish or negative growth. And that's negative. It's negative for the stock market, but it's also negative for the bond market. Why? I'm going to take you to that chart that you see in this slide. And if we go back in the 70s, we see that as stagflation, the blue line, increases, 10-year U.S. Treasury yields continue to increase. Why do they increase? Because there is inflation. The central bank cannot really initiate an interest rate cut cycle to stimulate growth because the upside risk to inflation remains, and that means that it has to remain hawkish, and therefore yields are on the rise. Now let's go instead to the ECB. The picture for the ECB is somewhat similar to the Federal Reserve. The ECB has gone through the most aggressive tightening cycle since it was established. It tightened over 15 months by 350 basis points. And inflation, it's still more than double than the ECB target. And therefore, we are seeing the ECB remaining and holding a hawkish bias. We have a problem though here, and the problem is the different cost of funding that there is in the European Union, and therefore the spreads that various countries have versus the German Bund. In this slide, I put the spread between the PTP Bund, which has reached around 200 basis points, and that's an alarming level. It's an alarming level because if the BTP Bund spread continues to widen, becomes a political problem for the ECB, because the ECB doesn't want the cost of funding to be particularly harsh. In Italy, you would like that cost of funding to be spread around the whole EU. And it's obviously a political problem for Italy, because the Italian politicians are saying, hey, why are you tightening? Why are you upset with us? Why are you tightening so much and punishing us like this? So this is a huge point. It's a point that is going to weigh throughout 2024 on the ECB, and we believe that it will arrive to a junction point where the ECB will need to choose between the periphery, so trying to subside that spread that you see over there, or the euro. And that's going to be a very difficult position to be in, because if they choose the euro, then we are going to have political issues in the euro area, and probably the spreads are going to widen across countries. And if you choose the periphery, then the euro will devalue if it cannot hike interest rates, and that devaluation could bring more inflationary pressure. So let's talk more under a practical point of view, how bonds can serve within this scenario, and how can help an investors within its portfolio. And when we look at how bonds, why we should add bonds in our portfolio, and how they work in a diversified portfolio, we have to take three elements in mind, which is inflation, duration, and quality. And here I'm going to go more in depth. So inflation. The expectations for inflation in 2024 is for the US to end the year at 2.7%, and in the euro area around 2.8%, and in the UK around 4.4%. Especially when we look at the European Union and the US, we can say that an inflation rate which is below 3% is hinting to the fact that we are reverting towards the 2%. The problem with that is that it really depends on multiple factors. These estimates were done well before the war between Israel and Hamas started. And if there is an escalation in geopolitical tensions, that could bring back a second wave of inflation. Why? Because on one hand, we are going to have more bond supply, which is going to be caused by more fiscal spending. We have Biden already in the US asking to approve $100 billion to help the war in Ukraine and in Israel. And on the other inflationary, more direct inflationary front, a war means disruptions. It means disruptions in getting commodities from one place to the other, and it can definitely affect also oil prices. So if we see inflation as a problem, what is that product that can protect me against that tail event? And that's TIPS, inflation linked bonds. Why they are a good instrument right now? They're a very good instrument because for the first time in 15 years, they're offering above 2% in yields. Actually, they vary from part of the yield curve. In TIPS, it's offering around 4% in yield. And once that you lock in that yield, if we have a second wave of inflation, then these securities are going to create a buffer against it. There is a catch though, and the catch is that TIPS are still sensitive to increasing rates, to raising rates increases. And so this is an instrument that brings value to a diversified portfolio when we are close to the end of an interest rate cycle, which we believe we are. But if the Federal Reserve hikes rate from 5.5% to, let's say, 10, 11%, a scenario that we don't believe it's going to happen, well, these instruments can still lose value because they have an exposure to both inflation and rates. But still, for long-term savers now, the 10-year tips offer around 2.5% in yield. That's the highest we have seen since before the global financial crisis. And that's a clean yield. It means that savers, if we have around 2% inflation, savers will get around 4.6% for the next 10 years. And whenever we have some sort of weakness in the economy, so let's say, for example, a sell-off in the stock market, or we have a sluggish economy and inflation is not anymore a concern, then we can expect the Federal Reserve to cut rates, and these instruments will benefit exactly like other fixed income instruments. So it's a nice and good instrument to bear, especially because it creates a buffer against tail events such as we described before. Then duration. Everybody asks me about duration, and everybody asks me almost daily, what do I think about the Austria bond with maturity in 100 years? And it's I put my thoughts into this chart that you see on the right-hand side. In blue is the Austria bond with maturity 2120, and in orange is the 10-year bond yields. The Austria bond went from around 140 at its peak to 35 cents on the dollar as 10-year bonds yield continue to rise. The problem with that bond is that the coupon is around 0.85%. So it has a modified duration of around 40%. It means that if yields drop or rise by 100 basis points of 1%, your capital appreciation will be around 40%. You will gain or lose 40%. And the thing is that, yes, it might be a good investment if in the short term we are going to see central banks cutting interest rates as aggressively. But the problem with that instrument is that if inflation remains elevated and central banks need to hold their position for longer, then they might continue to lose value. And once that you buy into these instruments because of its convexity and you start to lose money, the only thing that you can do is just hold this security until it rebounds. So we believe that as a risk reward doesn't make sense at the moment. We would like to have a better conviction that inflation is going to revert to its mean. So we are more patient on this kind of ultra long bonds because we still see a downside risk which might be brought upon by inflation. Then another example, and this is an example in the US and from an ETF, the TLT, very famous and very much talked about. It's an ETF that invests in US treasuries with maturity of more than 20 years. And then, as you can see, the blue line, which is the price of the TLT, fell from $160 to $88. But still, even though it started to drop since 2021 until today, fund flow continued to increase. So basically, that's quarterly. Yes, it's quarterly fund flows, and they have been picking up and growing constantly since 2021 until 2023. So the market is pretty much positioned on that to rebound, but the reality is that if it's true that we are going to have some sort of capitulation, these are the kind of flows that they need to disappear, and we need to capitulate. So it means that trade can go much lower. There is the risk, at least, that can go much lower. Then let's talk about quality, because we believe that it's key to remain in high quality products as the Federal Reserves and the ECB continue to stay on hold. And the reason for that is that there is a lot of pressure right now under many point of views. The real estate market, we have seen mortgages rates hitting 8% in the US. In the UK, the average mortgage rate went from 2% last year to 3% this year, and by the end of 2024 it should arrive to 5%. So the risk from the real estate markets continue to grow, and let's not mention credit real estate, which prices dropped around 75%. It's not a credit event, it's almost a bankruptcy event. So things are unfolding, and there is also other parts of the economy which we expect to suffer. Let's say, for example, the high yield bond segment. These are bonds with less than 5 years maturity, and their maturities starts to pick up in a couple of years. And these bonds have to refinance their debt at more than double the interest that they've been paying so far. So once that we see cash-strapped companies failing to price their debt at the market, in the market, we believe that these kind of weaknesses are going to be contagious and run very fast across all the credit segment. And just lastly, I wanted to mention also emerging market debt, hard currency debt in US dollar. This debt, the average interest or average coupon that is paid on this debt is around 4%. Now, if these emerging market countries need to refinance the debt, they would need to do so at 9%. And in the next 2 years, we have $500 billion in refinancing that need to happen within this space. So there is a lot of stress, if we think. I mentioned just high yield, emerging market, real estate, but I'm sure I'm forgetting some, and everything is coming to play. So that's why we talk about quality, and we talk about being cautious. So in this chart, in this slide, I believe it's one of the most effective charts that you will find out there, because what I've done here is that I've taken US Treasuries, bonds, and gilts, and I looked at these instruments in various maturities, 2, 10, and 30 years, and I assume a holding period of 1 year. And my question is, what is going to be my total return in 1 year if the yields is going to increase or drop by 50 or 100 basis points? There is a powerful message that this chart sends. If you are invested in short-term US Treasuries, so in this case, 2 years Treasuries, or let's talk about bonds and gilts, there is almost no way you are going to lose money. Actually, you're starting to lose money only if that yield goes up around 200 basis points. So in the case of the US Treasuries, if the yield on 2-year US Treasuries goes from 5% to 7%, you will start to lose money. But before that, you will not. And in that chart, even if the yield goes up by 100 basis points, you are making 4.23%. So that's a great part of the yield curve where to be invested in and wait for more favorable conditions to enter not only in the bond market and increase duration, but maybe also on the stock market. Then the 10 years, I think that this is also a space I like personally. It makes a lot of sense in terms of risk and reward for the simple reason that the 10 years is a safe haven. So whenever there is a collapse in the stock market or geopolitical tensions, we can expect that to go up. And in this case, what happens if the 10-year US Treasury yield goes from 4.75%. This chart was made a couple of weeks ago. Now it's much higher. What if the yield goes up towards 6%? Well, I'm going to lose only around 2%. So is that like a sensible loss to take to then invest in higher yielding opportunity? Yes, because that will create anyway a sort of buffer in case of a recession or a sell-off in the stock market. Of course, when we go longer duration, so the 30 years, the risk and reward becomes a little bit more skewed, and we still don't like that part for the simple reason that there is that kind of uncertainty of where inflation is going to go, and also not only that, but if you think about how many cuts can the Federal Reserve or the ECB do, that's also uncertain, in the meaning that if the Federal Reserve is able only to cut by 100 or 150 basis points in the next 2 years, that will still be supportive for high yields on the longer hand. So definitely we believe that until the macroeconomic backdrop becomes clearer, this is a place, the ultra long maturities bring too much risk, duration risk to one portfolio. And then finally, what I mentioned before about corporate bonds, just very quickly, whatever investment grade or non-investment grade, we don't like high yield, so junk issuers, and the reason it's very simple. The spread between high yield and investment grade corporate bonds, so basically the premium that you get by getting junk compared to investment grade, it's around the pre-COVID level in the US. So it's around 300 basis points, 3 full percentage points. But the big difference from 2019 until today is that in 2019, you didn't have interest rates at 5.5%. And we believe that's an area of stress, and that component will need to widen, and therefore that's why we don't like to be here. It's different for high yield corporate bonds in Europe. They offer almost 5 full points, percentage points above investment grade. This is one of the highest probably since the 2008 global financial crisis or the European sovereign crisis. But we cannot forget that if we see a sell-off in the stock market or a repricing of spreads in the US, then also the space will suffer. So definitely junk, not something we believe it's worth considering, but quality, high quality name, definitely they are a good chance. So high investment grade, corporate bonds, high quality names, where can we position? Well, in this chart, you see they are all tracking yields of US investment grade bonds with different maturities from 1 to 5 years, 5 to 10 years, and more than 10 years. What does that chart tell you is wherever you choose to be in the curve, in the investment grade curve, you are going to get the same yield, more or less. As you can see, in US dollar, you get on average around 6% in yield. And in euro, you're going to get for whatever maturity around 4.5%. So that's definitely you to decide whether you want to lock in that yield on the long run because you believe that that makes sense in terms of income, or if you want to take advantage of to take the least risk possible, so remaining removing that duration risk from your portfolio and look at the front end of the yield curve and waiting for better opportunities and signals to extend duration.
Thank you very much. It was a pleasure to hear your thoughts. Thank you.
Thank you for inviting me.